Hi there. Welcome to my channel on family mediation and divorce law and related topics. This is Anè Smit. Today I have a very special guest. It's Lise Van Malsen. She's a financial advisor at Liberty. Welcome, Lise.
Hi, Anè. Thank you very much for having me.
Lise, what is financial planning?
Financial planning is the process of determining your goals, your financial goals and aspirations, and then creating a plan on how you're going to achieve those goals and aspirations. And in terms of the kinds of things that we look at the person in a holistic way. We look at risk cover, retirement savings, and investment planning. So yeah.
Lise, why is this important?
Financial planning is important for the protection of you and your family's financial future. So it creates a goal for you, and it protects you in terms of if something should happen to you and something happens and you need to have a backup plan on a financial basis. So with this, like this, with this pandemic and the lockdown, many people didn't have any savings to fall back on. They didn't have any investments to access. So it just basically takes that worry away.
Lise, sorry, I see your dogs are also coming to say hi to the party, yeah?
Yeah, that's one of the things of working from home.
A lot of times we hear the terms provident fund and retirement annuity. Can you tell us what is the difference between the two?
A provident fund is a retirement investment vehicle where there is an employer-employee relationship. So you would do contributions, monthly contributions to your employer's fund, and then should you decide to leave your employer, that relationship comes to an end, and your provident fund then ends there. With a retirement annuity, there's no employer-employee relationship, and you can apply for that at any financial institution that provides those types of investment vehicles. You will also contribute a small amount per month, and you don't have to stop that at any stage until maturity.
So, Lisa, if I withdraw my provident fund from the company that I used to work with, and I want to reinvest the money, how do I go about to do that?
Okay, so when your employment ends, you have an option of either leaving the money with the employer where it is invested, or you can transfer it to your new employer, or you can transfer it to a provident preservation fund, and then with any financial institution, and they would then invest it the way you would like it invested.
When you refer to other policies, what is the difference between life insurance and disability and dreaded disease cover?
Okay, life insurance is where a lump sum is paid out. Your life is insured. Should you die, that lump sum will be paid out to your beneficiaries or to your estate to cover any debts on your estate. Disability is where you would benefit from that cover. So should you become disabled, you will get a lump sum payment to pay any extra medical expenses, to pay your wheelchair if you disabled in that way. Then also in terms of disability, it has a second aspect where you have an income protector, where if you cannot work anymore because of your disability, you will then get paid a monthly income, basically to replace your salary. Then in terms of dread disease, that pays a lump sum out to you should you become, should you contract a critical illness like cancer or heart disease, a stroke. You need hospitalization, you need extra medical care, you need, if you have to recuperate at home, you need a nurse to come to the house to check up on you. That's what that is for. And also, should you become or contract a disease, you can also claim on your income protector as well to replace your income, if so that you have time to, you know, to recover and emotionally recover and all those types of things.
Okay, and then obviously with this whole corona and pandemic thing, is there any cover that you can take out to make provision for retrenchment?
There's it's called a retrenchment protector. It pays your monthly salary or a percentage of the salary, depending what you've applied for. It pays it for that amount of time that you need to get a new job. So if you get a new job within 3 months, it will pay you your salary for those 3 months. But the maximum amount or maximum time it pays for is 6 months.
Okay, and then when I invest money, say to take out life insurance or retirement annuity, what happens to that money? When say I pay R1,000 on a policy, I take out a policy with you at Liberty, and then I basically investing R1,000 a month. What happens to that money?
Okay, so part of our job as financial planners is to determine what type of risk profile you have. So in terms of what type of investor you are. So are you a more aggressive investor, or do you like to take it more easy with a conservative investment? So being a conservative investor. So depending on what your profile, your risk profile is, we would then take your R1,000 and allocate it to the more aggressive funds if you are an aggressive investor, or to a more conservative fund if you are a conservative investor. So basically, then that money would be invested according to what your risk profile is.
Okay, so in other words, if I'm a much younger person in my early 20s, I will take a more aggressive approach than as opposed to somebody who's already in their 50s.
Absolutely, it is advisable to be more aggressive early on. When you are young, you have more time, basically time in the market to grow that money aggressively. So, but when you are older, like 50 and up, then you need to start conserving the money and start investing a little bit more conservative so that you do not lose the capital that you have built up over the years.
Lise, a lot of people have concerns because they want to invest money, they want to save, but they don't want the capital to diminish. How can you advise somebody to, when they want to take out a policy, to what kind of policy can they take out to ensure that the capital doesn't diminish?
Okay, so you can never protect the capital 100%. However, it is important to make sure that you diversify your portfolio. In other words, what I mean with diversify is to make sure that you don't put all your eggs in one basket. So basically, there are different asset classes in which you can invest. So you can invest in equities, which is shares on the stock market. You can invest in bonds, government bonds, parastatal bonds, or private bonds. You can invest in property, and you can invest in cash. So you need to make sure that you allocate a percentage of your total amount to each of those asset classes, depending on what type of investor you are. So if you are a more aggressive investor, you would put a little bit more into the stock market. If you are a conservative investor, you would put more towards cash and bonds. That preserves capital a little bit better than equities. So yeah, so you just need to make sure that you diversify your portfolio. And in any case, you know, the financial institutions, the asset managers do this for you, basically. You don't have to do it yourself. You can, you give the money to these managers, and they do the diversification on your behalf. So you basically need to just make sure that you invest in a reputable institution.
Lise, obviously, again, with this whole pandemic that we are facing with, a lot of people are concerned about the fact that they've invested money and now suddenly with the shares, the value starts to drop. People are concerned. They rather want to take the investments out while there are still money left. What would you advise people in situations like this?
Okay, so what people need to understand is investing is a long-term thing, basically. So you need to understand that investing works differently to like gravity. Gravity says that whatever goes up must come down. Investing is different. Whatever goes down must come up. So after every market crash, there will be a recovery. And you just need to make sure that you don't sell your assets when the market crashes. So basically, you have not realized any losses until you sell your assets. So that, yes, the market drops and it looks like you're making a loss, but you haven't made that loss until you sell your asset. So you need to just wait, sit tight and wait that the market recovers and that your investment recovers. So investing is a long-term strategy, and you need to stick to your goals, and you need to keep your money invested.
If I am now in a financial situation where I have to do early take money out of the policy at a premature stage from my retirement annuity or an insurance policy, how does that affect the capital and the monies that I've invested over the time?
Okay, so for a retirement annuity, you cannot access that money until the maturity of the policy, which is normally at retirement age. So what would happen is you would stop your contributions to that policy, and the funds that you have saved so far would just stay where it is, invested with the asset manager, and it will grow with the market. So if the market goes up, the value of your investment will increase. If it goes down, your value will decrease. So your money is your money that you have saved so far, and it just stays there. But it will not increase with compound interest that you would get if you had made additional contributions. So the money stays and it just grows with the market.
And then other insurance policies? Is there anything else that I could draw at this point if I need urgent cash flow?
Okay, it depends on what investment you've invested in. So if it was like a unit trust, then you can access money almost immediately within 2 or 3 days. You just give the asset manager the instruction to withdraw a certain amount, and they will do that for you and pay it into your bank account. Other investments is more of a long-term investment, like a 5-year investment. If you, within the 5 years, you cannot access that money before the 5 years are over. Otherwise, if the 5 years are over, you can immediately give an instruction to sell a portion or the full amount. Yeah, you can give the instruction to sell immediately.
Okay, but if I want to maybe, can I also not stop? What happens if I stop paying a life insurance or disability policy? Can I cash that out at a point?
Okay. In terms of life cover and disabilities, those are risk policies. So you pay a monthly amount to insure your risk cover. However, there is no investment value to that policy. So it's a policy where it's basically like car insurance. Like you pay a monthly amount in case something happens, they assist you to fix your car if you have an accident. So risk policy is exactly the same. It is just a payment that you make to ensure that if something happens to you, that you are protected. So there is no investment value to that policy, and you will not get money out should you stop not making payments. That policy will lapse, basically what we call lapse. So it would just become null and void, and your risk cover would stop.
Oh, so they won't pay you back the money that you've already to pay towards the policy?
No, that is pure insurance. Yeah, that's pure insurance to make sure that if something happens, you are protected. So there's no investment value there.
Okay, so if I'm in a position now that I can't pay my retirement annuity or my insurance cover due to the fact that I'm not earning an income, what other options do I have to maintain the policy?
Okay, so for a retirement annuity, the options that you have is you can either decrease your contribution to a lesser amount that would suit your budget, or you can stop payments or contributions totally, and therefore you will not be contributing anymore, but your investment would stay. And as I said before, your investment would just grow with the market. Then some institutions have different options, like Liberty, for instance, have an option where you can waiver your premium for a period of 6 months, maximum period of 6 months, which would then give you the opportunity to find other income streams where you can start making payments again once your income have stabilized.
So basically, Liberty will cover you for these 6 months. So if, for example, I get a payment holiday and I get into a very severe car accident, will I then still be able to claim on my policy?
What, in terms of the retirement?
No. In terms of, well, the retirement you've explained, it stays intact. But say, for example, now for the disability or income protection, if I don't pay during the 6 months, I will still have the same cover that I had. Or how does it?
Okay, in terms of risk cover, you can't stop payments completely because then your policy lapse. So that works a little bit different to a retirement annuity. What you can do is you can decrease the cover limits. So if you had a 1 million life cover and a 1 million disability, you can decrease those amounts to, like, say, 500,000, which would then obviously decrease your monthly premium to a minimum amount. The minimum amount for, well, in terms of a Liberty policy is 200 Rand. So you would still need to pay that 200 Rand to still have your cover. So should you stop the 200 Rand, your policy will lapse and you will not be covered anymore.
Okay, so the waiver then is not a complete waiver, it's just you pay less than what you would have otherwise paid.
Yes.
At a reduced cover.
In terms of a retirement annuity, you can stop completely and the policy is still in force. But risk cover works differently. It is insurance, so if you stop payments, your policy lapses and you will not be covered.
So if you want to claim from your policy, let's take your life insurance, for example, if you are deceased, how does your family go about to claim that from that insurance?
Okay, well, they would then need to put in a claim with the institution that the policy is with. They would need to provide a death certificate to the insurer so that the insurer can determine that, yes, that person is definitely deceased. And then the policy, they will check what is the life cover. They will also check why the person was deceased or died. So if it is in terms of like a suicide or drug overdoses, those types of things are not covered by an insurance policy, and they will not pay that amount out. So they will do an investigation of what the death was about. And according to that, they are going to pay or they are not going to pay.
Okay, and then your retirement annuity, do you just leave the money? Do they notify you, or how does it work when you want to claim on that?
Okay, so once you've hit retirement age, depending on what the age is stated on the policy. So if the policy says the maturity is at age 60, then you can claim only at age 60 on that policy. In terms of what you get out is there is legislation that guides you on that. So in terms of the Long-Term Pension Fund Act, you can only take one third lump sum of the cash that you've accumulated, and the other 2/3 you need to buy an annuity. An annuity means that they are going to pay you an income every month, depending on what you've stated you wanted on a monthly basis.
So if my policy, for example, matures at 55 and I decide, okay, I don't want to use the money, how does it work then? Can I reinvest it, or do they keep it in the policy to help the capital grow? How does it work?
Okay, so if the maturity is 55 and you decide you're carrying on working, the policy will just carry on. You will either keep on making contributions and it will carry on investing as you have done before, or you can stop payments and that money, it just stays and grows with the market.
Okay, so basically you will have to notify your financial advisor that what you want to do with the money. Otherwise it will just remain there. Okay.
Yes, exactly.
Lise, there's just one thing that I want to ask you, being in the mediations and all of that. A lot of clients don't understand the tax implications of when the provident or a pension fund or provident fund is withdrawn at an early stage. Can you just tell the clients briefly how does that that's the only exclusion that a person can withdraw at an early stage. So what is the tax implication for somebody that takes that money out of the provident fund and doesn't put it into another fund, but actually draws out the cash?
Okay, so you're going to be taxed on not the retirement table, the basically the transfer table. So the withdrawal tax table. So it depends on the amount that you want to withdraw. You will either pay, it's a sliding scale, you would either pay 18%. If it goes over an amount of 660,000 Rand, you will pay a certain amount plus 26%. So yeah, there's definitely tax implications, and it is advisable not to withdraw money from your retirement savings, but just to transfer the money to a preserver fund where you then don't pay any tax.
Yeah, I just want to clarify again for the viewers that we are referring here to situation where two people are getting divorced and they have a court order stating that one of the people are entitled to a percentage of the other person's retirement fund or provident fund, and that is what we are referring to. Obviously, as Lisa explained earlier on, that's the only circumstances under which you can withdraw from your provident fund or your retirement annuity. Lisa, thank you very much for your time. Can you please, if people would like to call you with any further answers, do you have any contact details that you can provide them with?
Yes, they can contact me on my email address. It is Lise, L-I-S-E, .Van Malsen, V-A-N-M-A-L-S-E-N, @liblink.co.za. Or they can give me a call on 082 339 0536. Yeah.
Thank you very much, Lisa. I will also put your details in on the comment box and also on my Facebook page, so that if people have any further queries relating to financial planning, that they can give you a call. Thank you very much for your time. Really appreciate it. And I hope we can have another meeting in the near future.
Thank you, Anè.